Hi, I'm Pattu from freefincal. Let's talk about what our investment strategy should be after the change in the debt fund taxation that's going to kick in from the 1st of April 2023. Many readers have written to us. Some have said something extreme, like they're going to stop investing in debt funds, they're going to invest only in fixed deposits, and so on. But uh, the point is that a change in tax rule should never ever change our investment strategy. Our investment strategy should be based on our goals, and our asset allocation should be based on our goals as well as our own risk awareness and our risk taking ability. For want of a better word, it's called as risk appetite. And so it's basically going to be, our portfolio is going to be diversified, and it has got to have the right mix of risk and reward as necessary for the goal. So you can't suddenly make changes to it just because you have to pay a little more tax. So, well, it depends on the person. So let's talk about that. So the point is that uh, the big problem with a bank deposit with a RD or an FD is that it's not liquid midway. You can't suddenly take a portion of that fixed deposit and push it into equity, or you can't take some equity and push it into the same fixed deposit. You can't do that. You can't break that FD without penalty and so on. So it's not liquid. For those who appreciate the importance of asset allocation and rebalancing, they will appreciate that a debt mutual fund is better than a fixed deposit. Of course, the reality is that most people do not have an investment plan. They don't care about their asset allocation, and they will never rebalance because they are scared of taxes. I'm not addressing those people. I'm addressing those people who do appreciate what an asset allocation is, and they will appreciate that a debt fund is better than a fixed deposit. Over 10 years or more than that, you have a reasonable chance of a corporate bond fund or a gilt fund beating the returns of a bank FD. And even before tax and after tax, because you have to pay TDS to a fixed deposit and you have to declare the tax every year and pay it, you will also the returns of a debt fund post tax will also be a little bit better. But most people are not ready for those kind of risks. But those who think that such risks are reasonable, and I believe that they are reasonable, I think debt funds are still the investments to go to instead of fixed deposit for a long term portfolio. Now, there has been discussion on choosing arbitrage funds instead of debt mutual funds. Arbitrage funds are short term investments. You can certainly use them for the short term, provided you don't have any great return expectation from them. But for the long term, it's a bit of a overkill, and you will not get, um, you know, they they are unlikely to beat a FD even before tax. That's my opinion. I think that's reasonable, because if more and more people go to arbitrage, also the opportunity size there will decrease, and again the returns will go down. So I would not use an arbitrage fund for long term returns, unless you say I just need a place to park my money. I don't care about return. That is fine. For example, in the case of my son's future goal, I have parked some money in arbitrage because I know that I'm going to use that money and spend it for college in a few years. I don't really care about returns. I just want some place where the volatility is less and I don't need to pay tax. So there, of course, definitely an arbitrage fund will help. Some people have said, how about equity savings fund? I am going to make a video on that separately. Equity savings funds comes with their own set of risks. They are not alternative to debt funds, and they will be sold as that. So what's going to happen now is that, assuming that the finance ministry is not going to relent, and I think they are not going to relent, the AMFI will now go and ask SEBI to allow some relaxation in its categorization rules. And if they relent, then there will be many fund investment mandate changes, like we discussed about quant balanced advantage fund, but that was an easy change to make. If SEBI also does not relent, then AMCs will start changing whatever they can. And then the smaller AMCs who don't have an aggressive hybrid fund, they will start launching a balanced hybrid fund with 40 to 60% equity. And also equity savings fund will be missold as an alternative to debt fund. That is definitely not true, and we have to be careful about that. I will talk about that later. Of course, informed investors who have got a lot of money already saved up, who are investing a lot of money every month, they can consider equity savings fund. There's nothing wrong in it. But people who call themselves as retail investors, they have to be careful with uh, equity savings fund. Another instance where fixed deposits can play a role instead of debt funds because of this rule change is, for example, in my son's future portfolio case, I that when I started it, it was 18-year goal. Today it's about 5 years, or 5 years goal, or less than, a little bit less than 5 year goal. So I can consider, investing in a RD or an FD for 5 years, which will mature at the time he gets ready for college. Because at this point in time, I'm not really worried too much about asset allocation. Already, I have to reduce my equity asset allocation. So there, in such cases, you can consider FDs or RDs. I mean, at the latter part of the portfolio, where I'm actually already have to taper my equity allocation, then uh, the so-called safe deposits will work. So it really depends on what you need to do. So finally, about international mutual funds. Now, most people who wanted to invest in international mutual fund, they would say that they want to do it for diversification. The truth is, they just saw something shiny. They saw something that giving huge returns, and they just wanted a piece of that action. Now, in the last few months, they have been witnessing the real benefits of such diversification. Real diversification means one component in your portfolio does better and another component in your portfolio does not do better. Now they have had first-hand experience of what proper diversification really means. So if you are really interested in such diversification, then I think you should continue investing in international funds. Some of them may change their investment mandate and hold more of Indian equity, but again, SEBI has to consent to that. So it's a lot depends on SEBI and how AMFI can convince SEBI to do it. But I think those of you who really want to diversification can continue in the international funds. But I have always said that don't invest in international funds. Stick to something like Parak Flexi Cap or Axis Global Opportunities or something where you really don't have to pay any extra tax for that equity exposure, international equity exposure. That has been my stance. But anyway, if you are going to continue investing, you'll have to continue investing. There's no nothing much you can do. Of course, if you're scared of the tax and stop investing, well, that makes no sense. I would say, if you are truly interested in diversification, you should continue. So that's about it. So there's going to be a lot of developments in this space in the coming weeks. So let's stay tuned and see what happens.